Hi there, I'm Jennifer Lee, Senior Economist of BMO Capital Markets Economics. Well, September 17th has come and gone, and the Federal Reserve did not raise rates. So what happened? If you read the Federal Reserve's press release, they said all the right things. They mentioned that the economy was improving moderately, household spending and business fixed investment were increasing moderately as well. Housing was picking up. The labor market was continuing to show signs of improvement. So what was the problem? Then, if you read the Fed's press release, the second paragraph, there was one telling line, and just let me read it to you right now. Recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. So that was the key statement. Then the the press conference began, and Fed Chair Yellen began speaking, and she was very, very dovish. She acknowledged that that financial market volatility that really kicked up in starting in July, and the slow pace of inflation gave them the comfort, I guess, of staying their hand and leaving rates on hold for that particular meeting. And this comes even though almost every economic indicator out there was throwing their support behind a Fed rate hike, but I guess it was just not meant to be for that particular meeting. Now, at the same time, Fed Chair Yellen remains quite comfortable with their view that inflation would slowly wind its way back to the 2% target at some point. And she acknowledged that there was a case to be made for rates to rise at that particular meeting. But again, given the heightened concerns about China and emerging markets, the potential negative impact that could have on the U.S. economy, not to mention their trading partners, of course, and that would put further downward pressure on oil prices and inflation. Well, that was enough reason for the Fed to stay on hold for that meeting. She basically, and the rest of the committee, they want to see more signs, and they want to be more comfortable with this first rate hike, and they want to see inflation again, picking up and at a stronger pace towards the 2% target. Now, all of that is not going to happen in the next month. You're not going to see a big change in the next month. So therefore, we are not of the view that they will raise rates in October. However, the meeting after that, which is on December 15th and 16th, that's almost 3 months away, and that should be ample time for the Fed to be comfortable to start raising rates from emergency low levels. So again, we are of the view that December will be we will see the first Fed rate hike in December. So what does this mean for the Bank of Canada? Well, it doesn't mean too much right now. I'm sure that the Bank of Canada officials are not too concerned about the loonie being at a decade low right now, and Governor Polaz and company are probably seizing on the fact that yes, the economy shrank for 5 months in a row, but it picked up markedly in June, and so far it looks like it's going to pick up again in July. So the downturn looks to be over for the most part, and the bank is looking for more signs of that rotation that we keep talking about. The rotation, seeing exports picking up, business investment picking up in response to stronger U.S. demand, and those would be the main growth drivers, and away from from Canadian consumer spending and housing. That is starting to take place, but the bank, much like the Fed, want to take their time and make sure that these growth drivers are starting to pick up. So we don't see the bank doing anything to monetary policy until probably early 2017. So they'll probably stay on hold for the rest of this year, 2016, and again, moving rates higher starting in about the spring of 2017. So bottom line, as I say, month after month, rates are going to start rising. The Fed will lead the rate hike parade, if you will, but any moves will be slow, gradual, and everything will be data dependent. Thank you.